All right, so we're doing chapter 18 tonight. It is an easier chapter. I think it's your easiest chapter of your final exam. So do a couple problems on it and then you should be good to go for your final. If it's online, which I believe it is, and I believe also it's not proctored, I'll post an Excel file, which is going to be like the worksheet that is in your notes, but the formula is already inputted. So you're just going to have to put in the numbers from your problems, and it's going to calculate everything as well as like the journal entry that you need. And yeah, so work a little bit with that Excel file and you should be okay for your exam. So a pension plan is what an employer is going to set up for their employees for the retirement of their employees. There's two types of pension plans. There's a defined contribution plan and a defined benefit plan. The difference between the two is that a contribution plan, the contributions that the employer are putting in the plan are already defined. So the employee knows that every month the employer is putting in $1,000 into their contribution plan. A defined benefit plan is that the employee is going to know when they're going to be retired, I'm going to get $1,000 per month. So the difference between the two is the timing of the benefit. For a defined contribution plan, the employer's contributions are defined. So the employers already know what they're putting in, but the employee are not going to know what they're going to get when they retired, because there could be fluctuation into the investment plan that the money was put in. So there's no promises of how much money the employee is going to get at their retirement. Sorry, my parents are here, so you might hear some background noise. So the risk is to the employee because the employee is not sure about what they're going to get when they retire. But under both contribution plans, under a contribution plan or the other one, a benefit plan, the amounts that the employer are putting into the plan are normally given to a third party, like a trust, that are going to be in charge of the money that is put in. So the money can be invested. The money could be, normally it's invested to get return on the plan, and that's how it grows. And the trust is going to be separate and distinct from the employer. So it's not the employer that's managing the contribution plan. How you record contribution plan is everything is expense when they are in the period that the employee is working. So let's say I'm working for my company and I get $1,000 per month, then the company is going to be expensing $1,000 per month for the financial statement for the employee. There's going to be a liability recorded at the end of the year if they haven't paid that $1,000 per month for every month. And there's going to be an asset that's going to be recorded if they paid more than $1,000 per month. For past service costs, if there's any, it's recognized immediately into an expense account. For interest expense, if there's an asset, that means that there's going to be more contribution during the year, so you might record an interest expense. And any interest earned on the assets, on the surplus contribution, is going to be deducted from the cost of the period. You don't really need to know how to account for it because it's not normally the one that's asked on your exam. This is more from common knowledge when you're going to be working. What's going to be asked on your exam is more a defined benefit plan, where the employer contributions aren't defined, but the employees' benefits are. So the employees are going to know, okay, when I retire, I know that I'm going to get $1,000 per month, regardless of what my employer put in when I was working. Also, when you're talking about defined benefit plan, there's a term that's called vesting, which means that if the employee has benefits that are vested and they leave the company, the employee still has rights to the benefits that were acquired when they were working. But if the benefits aren't vested and the employee leaves, then all the benefits that accumulated while he was working at the company are gone. So they have nothing when they're going to be retired from that company. So the longer you work for a company, the bigger is going to be the amount of the benefit you're gonna get when you retire. So if you work a year for a company and you have just your benefit for a year, then you're gonna have a smaller amount for your retirement. And if you work for 25 years, well, you have 25 years of benefits accumulating, and that's gonna be a bigger amount when you're retired. When you're gonna be recording the defined benefit plan, the objective is that your expense account and your liability account that are related to those plans are going to be recognized over the accounting period in which the employees provide the services to the company. So you want to account for the benefits while the employee is working at the company. There's two small differences between ASPE and IFRS when we're accounting for a defined benefit plan. Under ASPE, if there's any remeasurements, they are charged to net income, and under IFRS, they're charged to other comprehensive income. So the contribution of the employer while during the service term of the employee, they're going to put it in a trust, and the beneficiary of that trust is going to be the employer. And like I said, the trust is a separate entity. So the trust, the money that's put into that trust is going to be, belongs to the employer, so not the employee. And as long as the defined benefit plan continues, the employer is responsible for paying the defined benefits no matter what happens in the trust. So in the trust, what's going to happen is they're going to put the money, the cash that the employer contributed in it into investments. And those investments might go up and they might also go down. But regardless of what happens in the trust, the employer is required to provide the right amount of money to the employee when the employee retired. There's two accounts, big accounts that are going to be recording the employer's obligations. So the accrued benefit obligation account is a liability. So it's going to be, it increased as a credit. And that's going to be represent the employer's obligation to pay out the benefits in the future for their employee services up to the date of the statement of financial position. What this means is this is the amount that the employer needs to pay to all their employees in the future. And that amount is going to be estimated by actuaries because it is an estimate. You don't really know what's going to happen in the future, right? So you know the amount that you need to put in, but because of present value and stuff like that, actuaries are going to be determining the amount that you put in your financial statement to this date. And you also have the plan assets, which is basically the trust, and is the assets that you set aside to pay out the accrued benefit obligation. So that can be cash, that can be investments. The way that the accrued benefit obligation is calculated is like this. So you're adding up your current service costs, your past service costs, your interest costs, if there's any actuarial gain or loss, and you subtract the benefits that were paid during the year to employees. That gets your ending balance of that account. Current service costs are the cost of the benefits that are to be provided in the future in exchange for the services that the employees provide in the current period. So for your employees that are currently working at the company, they accumulate benefits during the year, and those benefits are the current service costs. The amount is going to be calculated by actuaries, and it's going to be given to you like as is in the problems. and it is expense under ASPE and IFRS. So you're going to have an expense account, and as a debit, and as your credit, you're going to have your ABO. Past service costs are when a defined benefit plan is started or amended, and there was employees that were working previous years that weren't entitled to the money of the benefits in those previous years because there wasn't any plan. So because of that, the company might have like paid them the amount that they could have been entitled to in the past years, and that's going to be a past service cost. What happens is that the actuary is going to be remeasuring your defined benefit obligation, and it's going to be bigger than it was before it was amended, or bigger than before it was started, because when it was started it was 0. So you can find it using this calculation, but also it's not every problem that's going to have past service cost. It needs to be stated explicitly in your problem that past service costs occur or are incurred on January 1st. So you need to have a little sentence saying that there is past service costs on January 1st. And just like current service costs, it's expense under ASPE and IFRS. For interest costs, there is interest that accrues on the defined benefit obligation, just like any other debt, and that interest is based on the outstanding DBO during the period. So your interest rate that you're using is the current market rate. That also is going to be given to you, and how you're going to find it is going to be the interest rate times your beginning defined benefit obligation plus your past service cost. So it's the same. It's the same formula as here, but here you were searching for the past service cost, and here you're searching for the interest cost, and it's expense under ASPE and IFRS. Then actual or gain or loss, it's when there is a change in the actuarial assumptions, and that also is going to be given to you in the problem, and it's expense under ASPE, but under IFRS it goes into your other comprehensive income. Then well, eventually you have to pay those benefits to the retirees. So when you're making payments of the pension benefits, it's going to reduce your plan asset balance under ASPE and IFRS, and it's also going to come and reduce your DBO balance under both methods. For your plan assets, so that's what's in your trust, how you calculate it, it's your expected return on asset plus your employer contribution plus the employee contribution, plus or minus the actual loss or gain minus the benefits paid, and that gives you your plan assets ending. This increases as a debit. So yes, it's the asset that has been set aside in a trust or other legal entity that is separate from the employer. Another thing is that the assets can only be used to pay out the benefits in the plan. They cannot put in the money into the plan asset or the trust and then decide to pay for material or a PP&E. You have to use that cash to pay for the benefits. So the expected return on assets, it's how much the company is expecting to have as an increase in their assets during the year or a decrease in their assets during the year. So it's their return on investment. The interest rate that is used is again the current market rate, and how you find it is the current market rate times the beginning balance of your plan assets. And that's going to come and be a benefit. So it's going to be a credit in your income statement, or reduce your expense amount. Your employer and employee contribution, it's what the cash amount that the employer and employee put into their benefit plan. So for the employer contribution, since you're the employer, then you reduce your cash amount. And for the employee contribution, it's the benefit under ASPE and IFRS. So it reduces your expense for the year. The actuarial loss on investments is the difference between what has actually occurred and the previous actual assumption about what would occur. So remember here we did expected return on assets. Well, you're going to have the actual return on assets, and the difference between the two is going to be called an actual loss or gain on your investments. So if your expected is smaller than your actual, then it's going to be a loss. And if your expected is greater than your actual, is going to be a gain. And it's expense under ASPE and OCI. Oh, and sorry, OCI under IFRS. So what's going to be happening here with your actual loss or gain? You want to take the amount that you had calculated for the expected return. And when you add your loss or gain, you want it to be equal to the actual return on investment into your plan asset account. So when we're going to be looking at the spreadsheet, I'm going to always be pointing out that the sum of the two is going to be equal to your actual return on investment. And then we get to this account, which is the net benefits asset liability account. So basically, this is the difference between your balance in your ABO account and in your plan asset account. They're not going to be equal, and that difference goes into this asset. If your ABO is greater than your plan assets, it's going to be underfunded, which is going to be a deficit liability. So this amount is going to be greater, this amount is going to be smaller, and the balance is going to go into this account. If your ABO is smaller than your plan asset, then your account is going to be overfunded. Sorry, your plan is going to be overfunded. And that's going to create a surplus, and that surplus is going to go into your net benefits asset liability account. So here's the spreadsheet that I have in Excel too. Everywhere where there's a star, it means that an amount goes there, and when there's some like brackets, it means that it's a negative. The sheet works as it's debit. So when there's brackets here, it means that it's a credit into your journal entry. So you see here, your accrued benefit obligation increases as a credit. And when we reduce the balance, it's actually a debit. And same thing here, your plan asset, it increases as a debit. And when we come and reduce it, it reduces it as a credit. And your journal entry is going to be found using the ending sum of all your columns, and they go and they plug into your journal entry here. That's pretty much it for the theory. I went more in details than honestly what you would need for your exam. So let's jump right into the problems. It's going to be a shorter tutorial tonight because it's a smaller chapter. So yay, after like the one.
Just a quick question. The sheet that you shown us, I'm guessing that it will not be posted. We have to make it ourselves, I guess.
Well, actually, I'm going to post a PowerPoint, and I'm also going to be posting this Excel sheet. It's already on Facebook from like last semester if you want to go see, but this is going to be posted also, so you can use this for your problems. Where was I? All right. This. So the first question is, you are elated to have landed the summer job of your dreams as an accounting intern for Hire and Fire Corporation, a national executive recruitment firm. Your supervisor and mentor, Beatrice, greets you with a tough assignment on your first day of work. She handed over a sheet containing some hastily scribbled notes and a comment. I wish to start you off with something light and easy. Here are some notes on our pension fund operations for 2017. Could you please sort this out by the end of the day? And yes, did I tell you our firm is currently with ASPE, but considering a switch to IFRS in 2021. The note contained the following information. The beginning projected benefits obligation, BPO, is $568,000. The plan is underfunded by 60% of this amount, and the regulatory agency considered this to be quite heavily underfunded. Prior service costs were recorded on January 1st, 2017. The amount is to be determined by us. The current service cost for 2017 amounted to $140,000. The plan uses an interest rate of 8%. We recorded an interest expense of $52,240 for 2017. Our investments of the plan assets did very poorly, earning only $13,178 on our plan assets in 2017. The corporate pension committee overseeing the plan operations had decided to fund an amount of $35,000 in addition to our normal annual contributions, which we make as per our corporate policy. The company normally contributes 5% of the BPO carried forward from 2016, plus 50% of the current service cost and 60% of any past service costs incurred during the year. Employees funded $20,000 to the plan as it is a contributory pension plan. Benefits payments for the year are $74,000. It was determined by the firm's actuaries that the ending balance of the plan assets appropriately reflected their fair market value, and the projected benefit obligation was revalued at the end of the year and should reflect a $50,000 reduction in the BPO otherwise determined. So a lot of info. A little while later, while you were still sorting things out, she arrives at your solid oak wood desk and gave you some more specific instruction. So give me a summary of the activities, showing them on a worksheet per ASPE. Prepare the journal entries, and what would have been the pension expense under IFRS? What would have been the amount? And give me some brief detail of how you came up with that number. So I'll copy my pension worksheet here. So the amount that are in green, that means that it's the same under IFRS and ASPE. Blue is ASPE and yellow is IFRS. So let's go back here. It said that the beginning BPO is $568,000. So we know here that my beginning balance is minus $568,000. Putting it as a negative because this account is a credit account. So when you're going to be putting your number here, when it goes up, it's a negative. When it goes down, it's a positive. So it's going to be a debit. Says that the plan is underfunded by 60% of this amount, and the regulatory agencies consider this to be quite heavily underfunded. So that means that here, underfunded, so your BPO or ABO is 100%, and it's going to be underfunded, so this is going to be greater than your plan asset. It's underfunded by 60%, so that means here in your net benefits asset liability, you're going to have the 60% of this amount, and here you're going to have 40% of the amount. Here, the 40% is going to be as positive because it is a debit account. So we're going to do minus 40% times the amount that we found in the ABO. And here, well, it's going to be, we can just do the sum of the two, which is going to give you minus 340. Or when it's under, or you can find 60% of this, and since it's underfunded, it's a negative. We don't know what the prior service costs were on January 1st, but we know that the current service costs are $140,000. So I'm going to put here the current service cost, so it's $140,000. And to find the past service costs, we have a formula to find this. And the formula is going to be using the net interest cost. Now, do we have that? Do we have the full amount of the interest cost for the year? Yes. They recorded for the year an interest expense of $52,240. So I'm going to put it here. And I'm going to be using this amount to find my past service costs because it is used in calculating the amount. So to find my past service costs, I'm going to do the 52,240 divided by my market rate of 8% minus my, oops, well, it's going to be plus my ABO amount. So that gives me 85,000. So I'm going to put here the formula. All right. Here it says that our investment of the plan assets did very poorly, earning only 13,178. So here we have the actual return. The actual return is going to be helpful when we try and find the actual loss on investment. But before we find that amount, we need to find the expected return on assets. And to find that, we use our market rate of 8% times the beginning balance of the plan asset, which is 227,000. And this is going to be as a minus because our expected return on assets should increase our plan assets. So here it should be as a positive to increase our plan assets. So that's why I put it here as a negative. We're using ASPE. So for the actual loss, I'm going to calculate it here. So the actual loss is your difference between your expected and your actual. You want here that the sum of these two give you 13,178. All right. So you want to come and reduce your amount here to 13,178. So I'm going to do 18,176 minus my actual return of 13,178. And that gives me 4,998. And it comes as a negative here in my plan assets. And if I add the two together, I get an actual return of 13,170, which is what you want. You want your actual return when you sum the two together. Then we have the contributions for the year. So the contributions go here in cash, and it's a negative account amount. Hold on. So the contribution, it says that it's 35,000 plus 5% of the BPO carried forward from 2016. Here I put a minus here to bring it back as like a positive amount. Plus 50% of your current service costs for the year, so 50% of 140, plus 60% of past service costs. I want this total amount to be a negative because we're putting cash into our plan assets, so that's reducing our cash and increasing our plan assets. The employees funded 20,000 to the plan as it is a contributory pension plan. So this comes and reduces our expense and increases our plan assets. The benefits payment for the year were 74,000. So that comes and reduces both your BPO and your plan assets. So it's going to be a debit here and a credit here to decrease both amounts. Then the projected benefit obligation was revalued at the end of the year and should reflect a 50,000 reduction in the BPO otherwise determined. So what this means is we have our balance here of our BPO of 771,000, but it should be 50,000 less. So it should be a reduction. So since it's negative, I'm adding it up. Oops. oops, plus 50,000. So it should be 721,000 instead of 71. So I want to come and add as a positive the 50,000 here. So I'm going to put my actual loss as minus 50,000 here. And here it should come and increase your, well, decrease your balance to 71,240. So we completed the worksheet. Any questions? Because I feel like I went kind of fast. No?
How did you get the 18,176? I just copied the number. I didn't actually.
Here. So it's your expected return on your plan asset. So how you find it is you take your market rate, which is going to be given in your column. So here it's 8% times your beginning balance of your plan assets. Yes, so for the end, I'll remove the amounts here. So it says that the BPO was revalued at the end of the year and should reflect a $50,000 reduction in the BPO otherwise determined. So that means that we found a balance here at the end of the year of 771,000. But the actuary says, no, it should be actually 50,000 less than what it is here. So you want to have a loss of 50,000. That comes and adds up here to bring it down to 721,000. So if I do minus 50,000 here, it means I'm going to do plus 50,000 here. And I know it's a reduction and you're putting it as a plus, but remember here, your balance is a credit. So you can ignore the minus signs and just look at it as a full value and say, okay, I had a balance of 71,240 credits, and I want to bring it down to 71,240 credits. And to do that, I need to add 50,000 debit to my account. No problem. So for the journal entries, since you have the worksheet, it's pretty easy. Everything is already there. So your first is going to be your pension expense entry. So it goes pension expense to your accrued, should remove the equal, accrued net benefits asset liability, pretty long account. So the amount that you put here is the sum of your benefit expense account. And same amount here that you find here, but now I'm going to put it as absolute value. So your pension expense is going to be of 194,000 for the year, and that goes into your accrued net benefit asset liability account. Then you have your cash payment for the year, and that goes and increases your this long account and decreases your cash by 184,400. And that's it for the journal entries. Then what would have been the pension expense if it was with IFRS instead of ASPE? So the only difference between ASPE and IFRS are the losses, the actual losses. So your benefit expense, well, sorry, your pension expense for the year would be, well, you would add back this. So it would be greater than under ASPE. Let's calculate it. So see, so the pension expense under ASPE is of 194.62. To get to the pension expense under IFRS, we have to remove the gain, no, remove the loss and remove the gain. So we're going to have the actual loss on BPO, which is going to be minus this amount. And we're going to have the oh, sorry, the actual loss on investment and the actuarial gain, right? If it's a credit, it's a gain on BPO of 50,000, which you're gonna add back because it reduced it before. So that gives you a pension expense under IFRS of $239,000. So in your books, if you were using IFRS, instead of having this amount here, you would have had this. And that's it for question 1. I'll stay on this for a little bit, but if you have any questions, just let me know. All right, for question 2, same thing, but now we're going to be using IFRS instead of ASCII. Oops. I'm going to copy this again. So for question 2, in late 2000, yeah, I think someone was talking. No? Okay, just my mind. In late 2000, Bunky Waves Limited established a defined benefit pension plan for its employees. At the inception of the plan, it was decided that both the interest expense accruing on the defined benefits obligation and the expected returns on the plan assets would be computed only on the balances existing at the beginning of the year. That doesn't tell you much. Further, such balances would be adjusted for any changes affected by transactions occurring at the beginning of the year. For the year 2015, the following information was provided to you by a trainee accountant of the company. Bunky Waves followed IFRS procedures and ended its accounting year on December 31st. The discount rate as well as the expected rate of return on plan asset was set as 5% per year. The accountant did not remember the beginning balance of either the DBO or the plan assets. Oh, he was so disorganized. Fortunately, he did recall that the interest expense for the year was $136,500. So I'm going to come and put it here right now. So $136,500. He also complained that the investment committee was, in his opinion, not doing a good job as the actual returns amounted to only $57,330, which resulted in an annual return of a poor 3.5% rate of return. So this is interesting. So we know that the actual return is this amount, and we know that the actual return is only 3.5% instead of the expected 5%. So with this amount, we can calculate our beginning balance of the plan assets. We can, after that, compute our expected return on assets. And after that, calculate our actual loss, or, well, it's going to be a loss here, on our investment. So to calculate the beginning balance of the plan assets, I'm going to take my actual return of $57,330 and divided by the 3.5%. So that gives me a beginning balance of 1.6 million. To find my expected return on assets, I'm going to take my beginning balance times my expected rate of return of 5%. So that gives me an expected return of 81,900. Then, since we know the actual and the expected, we can find our loss. So the loss will be of 81,900 minus the actual 57,330. If I sum the two together, it gives me 57,330, which is my actual return on plan assets, which is the actual amount by which my plan asset increased during the year. He then proceeded to read out a bunch of figures, 201,000 for current service costs, $60,000 for past service costs. $312 paid to existing retirees. So this is the benefit space, so it comes and reduce my DBO and my plan assets. And $240,000 received from the company as the annual funding for the plan. So my cash, we spend $240,000 for the year. Upon quizzing him further, you also learned that the funding status at the beginning of the year reported an underfunded funding. So here it's going to be a negative, and the DBO, ABO is going to be greater than your plan asset. And the plan assets are 60% of the DBO. So to find my DBO, that means I'm going to divide my plan asset amount by 60%. So that gives me a beginning balance of $2,730,000. And my net benefits assets liability is going to be the sum of the two of $1,092,000. You can also find it by doing 40% of your beginning amount here. Where was I? In each alternate year, so every odd year, following inception of the plan, the actuary remeasures the defined benefit obligation arising from employee services and recommended that the plan amount its accounting figures accordingly. We're in 2015, so that's going to happen this year. The actuary would also revise estimate parameters based upon his latest estimates. For the 2-year period ended 2015, the revised estimate for the defined benefit obligations amounted to $2,955,000. So that means that, like in the previous problem, your ending balance of your DBO should be of $2,955,000, but right now it's at $2.8 million. So you want to increase it by $139,500. So that's going to be your actuarial loss for the year. Did I? Oh, it should be as a minus here because we're increasing it. All right, so gives us the 2.9 million that the actuaries estimated for the year. Then they ask us to prepare the journal entries and what would have been the pension expense if it were following ASPE and set it back for us. So here it's a little bit different because you have your gain or loss under LCI. So it comes and changes a little bit your entries, but not by that much. So you have your pension expense, which is going to be the $315,000. You're going to have an increase in your OCI, well, a decrease in your OCI of $164,070. I know I put it in as a debit because here it's a positive. If it was a negative, then you would have put it your OCI account as a credit. And then you have your net benefits asset liability account for the sum of the two, which is the amount here, because my worksheet doesn't calculate everything. So it's the amount here. And then you have the journal entry for the amounts that you actually paid cash into your pension plan. So it's going to be the $240,000. I don't think I mentioned it before, but if you want to check if you did it all right here, you can check if the sum of the two of your ABO and plan assets together is equal to the sum of your net benefits asset liability account. And I can see here that it's not the case. So that means that I'm missing some things. Yeah, I'm missing the adding up here. So the sum of the two is equal to 1,331,000, which is the same as the ending balance of my net benefits asset account. Then if it was under ASCII instead of IFRS, if I start from my pension expense under IFRS, which is of 315,000, I had my actuarial loss on investment, which was of 24,570. So if it was under ASPE, this would have been added up to my pension expense account. And my actuarial loss on ABO would also have been added to my pension expense. So that would have given me a pension expense under ASPE of $479,000. And that's pretty much it for tonight. It was a quick one. Do you guys have any questions on the chapters or the problems?